Thank you.
At the single name level in tech this week has been unreal. Apple may be the relative standout. I've been excited for this interview for a number of weeks now, and I'm pleased to say that Hugh Hendry, formerly of Eclectica, is with us around the table. Good to see you, Hugh. I don't look cool enough sitting next to you. I think I'm going to have to lose this tie in a minute. Thanks for coming into New York. I want to start with this. It's a comment I heard on your podcast, The Asset Capitalist, about a month or so ago. And you had an investor on that used a line that I've heard a million times. We've all heard it a million times. I'm long equities because over the 5-year period, usually equities provide me with a positive return. And you questioned that, and I think we all need to question that in this environment. What did you say back?
Well, I mean, it's you know, the Warren Buffett line, never short America, and I certainly don't want to go against that. But also it's the conceit and the arrogance of a well-formed argument. It is true. There has never been a 10-year rolling period where it has not been the right thing to be long. That doesn't make it right moving forward. You know, there had never been a period where nationwide US house prices had fallen together until it happened. And when it happened, it devastated the global financial system. And today, we're still trapped in the mire of what happened 15 years ago.
So you're saying that a century's worth of market data is not long enough? Do you have to take history back a little bit further? Is that how you think about this?
No. I mean, no, this is Asian philosophy. You only free yourself from the shackles of being a slave to market rhythms when you recognize the impermanence of things. Things change. Things like the Fed put. Things like the Fed's understanding of money. Things like the devotion to Dan in his rather spectacular jacket and his recommendation for Apple.
Yep.
Things change.
Do you think the Fed's in a policy trap?
I think the Fed is confronted with Fed fog. Okay, I mean, again, I keep asking people, when was the last time we admired a step taken by the Fed that we thought, wow, yeah, that really has helped my life? Why is the default position to crash the economy?
So the hikes are the wrong call?
I believe the hikes will not result. They're dealing with a political problem that generated, hey, listen, without a doubt, we have seen an elevation to the tune of 10% in general global prices, right? And that 10% ain't coming back to zero. But for me, it's an elephant passing through the body of a snake, if you will, right? It refers to a supply shock, okay? It's gone. We're looking at Amazon's results, okay? Amazon had 100 warehouses full of inventory.
Sure.
Because they overestimated. And what's your headline again? We're looking at Amazon's worst holiday sales ever, okay? And we've had 2 consecutive quarters of GDP decline, and the Fed saying, recession? What recession? This is a recession that's getting bigger and bigger, and that's the fog.
You've picked up on it, the mismatch between demand and capacity. And there was a clear mismatch in 2020, 2021, but it was different. We didn't have the capacity, we just had tons of demand. Is it flipped already? Is that what you're seeing major signs of, that that's flipped already? And what does that speak to when it comes to the inflation call?
It's flipped. I mean, show me the evidence in the commodity sector in terms of the higher prices. Yeah? Show me the evidence. Actually, I'll show you the evidence in terms of the household's reaction. There's a default reaction whereby, think of the economy as like one giant wallet, okay? And the expenditure going out, we know, is up 10%, right, in general prices, okay?
Sure.
And so if you maintain your average consumption of goods and services, you need 10% more money coming into the wallet, okay? I don't see it coming in. This is back to the Friedman notion that inflation is always and everywhere a monetary phenomenon. You need a spigot of 10% coming in to accommodate. If it's not coming in, you're cutting back. Where are you cutting back? On discretionary spending. Let's look at every discretionary stock in the market. Where is it? It's on its ass.
So if we start a hedge fund tomorrow and we put together an investor committee, I'd have Mohammed Al-Erin as the chair to keep us well behaved through the whole meeting. I would have the likes of Druckenmiller there, the ingenuity of Druckenmiller. I'd have the conviction of a 90s Soros. I'd have the discipline of, say, Michael Platt over at Bluecrest. And I'd have you at the end of the table throwing grenades, saying, what if? If you could say what if right now, what is the big what if for you?
Heavens, you need a joker, yeah. So it's the unintended consequences. And I keep looking with a wary eye at our Chinese cousins and friends, and I look at their currency, you've got to remember that they were allowed to devalue back in 1994 with NAFTA, yeah, to 9. Where's the currency today? It's like knocking on 7.5, right? It's having, like all currencies vis-a-vis the dollar, it's having one of its weakest, if not its weakest year-to-date performance. Heaven forbid it trades 9, because that's where the yen is going. This is it's an Aesop fable. Yeah, why did the scorpion sting the frog halfway over? It's a bit like, why did Taiwan in 1998 devalue? There was no economic rationale. But when all the mercantilists are devaluing, boom, I can't give it up. That, God forbid that happens. That would be the most deflationary item to ever hit the global monetary system.
Is that something you'd be willing to position for right now?
Yes.
What would that look like?
Oh, that's just that. That's a short position in the currency.
How would you express it elsewhere?
Well, you know, elsewhere with restraint. Like I keep saying, you don't always have to be invested in markets. People say, give me a safe, give me a riskless asset. Well, you know, I've lived long enough. I lived through 2008, and the safe asset, supposedly, gold, went from near 1,000 to near 500 because we got liquidation. Okay, so for me just now, listen, it used to be, you mentioned 2018, 19, the Fed was raising rates, the S&P went down 20%, the Fed went, I changed my mind.
Yep.
Yeah. Well, we hit 20, we hit 25, the Fed went, no, not this time, so maybe it's 30, maybe it's 35. Okay, my comfort level for trying to own any asset arrives when we pass 35 or 40.
You said something interesting a moment ago, though. You said many interesting things, but the one was that gold didn't perform. The asset that was meant to perform didn't perform. Is that treasuries right now, or do you think the surprise is still in our future?
This is the killing zone for treasuries presently, just chart-wise. Like this is where, you know, we'll see. Either the treasury bond bull market is over, and so yields will continue, or this is the point where we're just recirculating ownership. But in terms of, let's talk gold, let's talk treasuries, real rates, if we look at 5-year tips, are close on 2%. Our system doesn't work, and gold doesn't work when rates are positive, real rates are positive. Think of it, we've got debt to GDP circa 4x, okay? If real rates are 2, you're effectively transferring 8% of GDP from the debtor class, from the household sector, to the creditors, and the creditors have got no idea how to spend money. That's regressive, right? We need financial repression. It's just simple a function of the maths of 4 times GDP.
You're going to stick with us. I'm going to lose this tie. You know, we're going to catch up with Guy Johnson in London in just a moment.
Cool.
Team effort. Up next, the latest inflation numbers out of Europe, piling the pressure on the ECB.
Inflation remains far too high and will stay above our target for an extended period.
That conversation continues. You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, you know, we have a unique way that we look at big new investments, and I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs. And the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
Inflation remains far too high and will stay above our target for an extended period. In September, euro area inflation reached 9.9%. In recent months, soaring energy and food prices, supply bottlenecks, and the post-pandemic recovery in demand have led to a broadening of price pressures and an increase in inflation.
The pressure mounting on the ECB to deliver rate hikes just 24 hours after its last meeting. A host of inflation numbers out of Europe surprising to the upside and renewing recession fears. Guy Johnson out of London now. Guy, that print out of Germany, 11 handle.
You have got to go back to the 1950s. You've got to go back to West Germany, John, to see a number as high as that out of Germany. The Italian number was pretty ugly. The Spanish number was okay, but broadly, inflation is elevated and is likely to remain elevated within the Eurozone. I talked to Peter Pratt yesterday, the former chief economist at the bank, and he was talking about the fact that Lagarde was, for the first time in a long time, he thought, balanced. She was acknowledging the risks to the downside, and she was accepting the risk to the upside on inflation. They want to manage it on a meeting-by-meeting basis, John, but I think if you see data like this, that is going to be a huge struggle for them. And I think a lot of the more hawkish members of the Governing Council are going to be saying, any idea that we were going to 50 is going to be tougher after today. We'll wait for the final number, the Eurozone number, but the German number is a big problem.
Hey, Guy, we all go back a long, long time. I think you and Hugh go back about 10 years further, so I've cancelled the next break so we can have a bit of fun here and talk a little bit longer. Hugh, did you ever think we'd see an 11 handle on German CPI?
Well, we're talking about going back to the 50s. Let's keep going back. Let's go back to 1948, when US CPI was running at 20%. And yet we don't talk about the hyperinflation of the late 1940s. Again, why? Because inflation is a monetary phenomenon, right? It requires, like, here we are getting funky in the studios of Bloomberg, right? But it requires funky banks saying, yeah, I want to lend. Do you see that in Europe? I don't see that in Europe, right? I see an elevation in the energy, right? And I see, believe me, right, the blindest bat of the central banking community is the ECB, right? The guys who raised rates in the summer of 2008.
And again in 2011.
And 2011, and what, they just doubled rates yesterday. Hallelujah, right? I'm thinking the other way.
You think the mistake is what?
I think the mistake is they don't understand that monetary conditions, they talk about financial conditions, monetary conditions, okay, have superseded their ability to see the entire picture. We're talking about the repo market, the euro-dollar market. We're talking about where monetary creation is no longer taking place within the sovereignty of their realm. They don't see it, and bad things are happening. The collateral is being called, okay? Money is actually being destroyed. The euro-dollar system just now is destroying, is contracting. Money is contracting, and it's pushing asset prices down. And it's a reflexive system. That's what they don't see. That will be the solution moving forward.
Guy, jump in here.
Well, I'm curious, Hugh, central bank independence, it's a very new phenomenon, and I wonder whether or not we're about to see potentially that being tested as well. Giorgia Meloni in Italy is already questioning the rate at which the ECB is raising rates. She, as you say, talk about the fact that this is a supply side problem that we've got here. It's not a demand issue that the Eurozone is facing. You've got the French president starting to talk about it as well. Others are likely to follow. How big a clash do you think we could see between politicians and central bankers, and who do you think will win that fight?
Well, I would extend that outside the European region to where you are in the UK. I think you just saw a cabal of the Bank of England chief and the jokers at the IMF, forgive me, but you know, ousting the British Prime Minister for having the audacity to suggest a fiscal expansion in a depression. UK prices, the UK stock index is below where it was when we entered this new century, right? It's not growing. And what is the answer? To raise interest rates? I mean, what planet are these people on?
So what do you think the central bank should have done? What should Governor Bailey have done? Accommodate?
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun.
We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
It's like that, and you've got to expand your vision, and when you're out here, you're seeing dead people.
So we've got about 60 seconds left, and I hope you're not actually seeing dead people. Let's finish here. If I could summarize this conversation we've had, you're pushing back quite aggressively against recency bias, and we're all sort of blinded by what's happened recently. Is that the ultimate gist of what you're trying to communicate here?
It is, and I think we have to recognize that all of the fascination, we have to go back 120 years to Germany and the Weimar and the inflation. Why has it not happened here? Because we have fire breaks. We have the outsized position of publicly traded debt markets. And they reprice immediately, and they tighten policy, not the Federal Reserve. We have discretionary spending where people pull back. That's what's happening. And those two factors together usually mean that the inflation fear remains a fear, and as we move forward, metaphorically, I'm seeing dead people. Okay, and the Fed seems to be, that's what the Fed's doing. It has to trash our system.
Yeah.
Once we're all aware of how bad it really is, thank you, Amazon, for again guiding us that way, then the Fed will pivot.
10 seconds to make a trade, literally 10 seconds. If you could make one right now, what is it?
When I look at collateral, I'm beginning to, again, the Italian BTP spread versus Boons, right?
Yeah.
Only 15% of Boons are in market hands, okay? And the Italian is being used as collateral as if it was a Boon. Italy is not Germany.
Hugh, it was longer than 10 seconds, but we got to go. Hugh Hendry, thank you, buddy. It's good to see you. Thanks to Guy as well. Live from New York. This was the countdown to the Open.